Welcome back to the Corrective Trading Strategy course. In this video, we're going to be talking about the theory and we're going to go a little bit deeper into each of the concepts. I think it's really important as traders, especially when learning a new strategy, understand the strategy, understand why it works, understand the key concepts behind that, and really dive a bit deeper into this trading strategy. I do apologize if I'm repeating anything I've said in other videos or future videos. The purpose of this is to really help you absorb the concepts, absorb the ideas, go into each part, give you a bit of background on the strategy, a background on why it works, dive deeper into the analysis, the statistics, a bit of everything. So we're going to cover quite a lot of different stuff here. And yeah, let's advance straight into it. So you might have seen me talk about this before, but one of the key things that we need to understand with any market is the market first of all moves in waves, right? The market moves in waves. It doesn't move in a straight line. It doesn't move sideways. It is always moving in waves. That's a very important thing. Secondly, the market has impulses and corrections. The impulses, these sharp moves, these directional moves, up or down, either way. An impulse is a solid move in one direction that happens normally in a short amount of time. Normally a sharp move, and normally going against the trend or with the trend. It can be either one. It can be a reversal or it can be a trend move. But nonetheless, it's a directional move that we're going to dive into shortly after. After impulses, we have corrections. The market corrects. You might have heard this in elliott wave theory or other technical analysis theories. After impulses, there are corrections. Again, the market doesn't move in a straight line. The market pulls back. The market sometimes reverses. The market sometimes collapses when it hits a particular level or a particular price. Then another thing that we've got to think about is accumulation and distribution. So the market accumulates at certain prices when buyers are accumulating positions, when institutions are accumulating long positions, and the opposite happens as well with distribution when institutions or large fund managers or large players, the whales, they are building a short position or exiting existing longs slowly. These big players, if they do all their orders at one price, they're going to move the market, and they don't want to move the market. They want to act undetected because there's a lot of risk if other players can detect someone who's putting a big position on, they can take advantage of that. So these are topics that we're going to go into each individually. Just wanted to give you a bit of background. So first of all is impulses. As I've mentioned before with the corrective trading strategy, this is the key part of the strategy. So important. It's so important that we get this part right. If we identify the impulse wrong, the trade is not going to work. It's not going to be a winning trade, and we put ourselves at risk. This is the only semi-subjective part of the strategy because it's on the trader to identify the impulse. And if we draw the impulse wrong, then you could be getting into losing trades, which is not ideal. Now, as I mentioned, sharp moves in one direction. That's how we can simply say what an impulse is. What does it shows? Aggressive buying and aggressive selling. It also shows often institutional activity. So large orders are being executed in the market. Maybe in the instance on the right-hand side, in this example, when the market is rallying hard like this, people are pulling their sell orders. People are pulling away their sell orders from the market, pulling those orders from the market. So it takes less buyers to actually drive the price higher. And this is something that you'll be able to understand in more detail if you get experience watching a futures ladder and how price order flows. That I will also go into later. And what else? Lastly, impulses, they show emotions. So emotions in the market. They show, in the instance of a crash or a sharp move down, it often shows fear in the market. In the instance of a rally, it can be showing greed or it can be showing, again, fear. They're those key emotions that we experience as traders. And then on the bottom here, I've just got a little example of how these, you get an impulse, then you get a retracement or a correction, then an impulse, retracement or correction, then another impulse. So these are examples of the way that the market can move. They move in these impulse waves and then they move in these retracements. Now, if we go a bit deeper into corrections, again, this is a big part of the corrective strategy, and this is what we are looking at as traders. So often, when people learn to trade and when people go online and they learn how to trade strategies, most of the content out there is particularly focused around trend trading. The trend is your friend, go with the trend, buy with the trend, etc. And yeah, there are some reasons for that, and there are some good points within that. But what we're trying to do is we're trying to develop an edge. And we're trying to go against the grain and not just do what everyone else does, so that we can be undetected in the market. We can just take our little slice. We don't have to try and get these whole big moves. We don't have to try and get everything in the market. We just need to be able to take a small slice, our own little slice, consistently. That's the key. Consistently take a slice from the market. It's trillions trading every day. We only need a very small slice of that each to live a good life. So on the left, we see a typical Elliott wave chart, how you've got these impulses and corrections, and you've also got it split into phases. So on the left-hand side, this whole phase can be considered an impulse phase, and then this whole side, the right-hand side, can be considered a corrective phase. But then within each of these impulses, they're their own correction phases. Just by looking at that already, you can get an understanding of how there are many trade opportunities and corrective trading opportunities in the market, and that they're happening at multiple levels, multiple time frames. And there are many opportunities. So we're definitely not going to be short of trades looking for these corrective trades. Often we can get in and out very quickly, which for me personally, I quite like to be able to just get in and out within the same day, or sometimes minutes, sometimes hours. It's nice. We don't have to stress too much about holding trades, although sometimes I will hold trades depending on the situation. Onto the middle chart we can see here. Yeah, there are stock market corrections. There are stock market crashes. There are these phases in every market. So we need to be aware of this. There are bullish phases in the market, there are bearish phases in the market, there are crashes, there are these aggressive pullbacks, these aggressive corrections. So every market has the cyclical part to it, and these are very nice. And then on the right hand side, we've got an example of a corrective trade. It's actually a trade I've taken before. We had that nice impulse, we had a nice box being formed, a rally of that box, a spike on the news, and then a collapse. It's a great example. Now, wave theory, again, this is something I think every trader should learn. I don't claim to be an Elliott wave expert. However, it's something I've looked into quite a lot over the years. It's very interesting philosophy. You know, it goes back decades and decades when it was Elliott had written his theory, his technical analysis theory. The key thing behind it is that psychology moves markets. At the end of the day, that is the most important thing. And when we look at any chart, we are just identifying the psychology of the market. These impulses, they represent the collective mind of all the participants, because that's all. Every price chart, that's all it is. It's just a collection of people's thoughts, people's ideas about a particular price, and people's ideas about whether something is expensive or cheap, or whether they want to sell that asset or they want to buy that asset. It's all emotion in the market, and that's what Elliott Waves aims to do. It aims to predict movements based on cyclical patterns that happen. And they happen because, you know, human beings are creatures of habit, and we do the same things over and over again, and this happens in the market. There are, in the Elliott wave theory, multiple different setups and strategies, different kinds of trading opportunities that you can take based on elements of the theory. But one that the corrective strategy is a little bit similar to in some ways, and sometimes there's a layover, is the expanded flat and the running flat trades. As we can see, these look very similar to the corrective strategy, where you have these wave down, you have this small retracement, and then you have another wave lower, and then you have a deeper correction, sometimes correcting below where the starting point happened. Again, on the running flat as well, you get these shallow retracements. Market overextends too far, then you have these collapses in the market. So that's something to be aware of when trading these markets, and to be on top of. This is one of the reasons why the corrective strategy works so well, because it overlaps with other concepts and other strategies. It overlaps with the psychological aspect, that these psychological patterns, they repeat themselves over and over again, and that's what we're doing with the corrective strategy. We are taking advantage of a psychological pattern alongside a technical pattern, alongside manipulation pattern, which is happening in the markets, you know, with market manipulation and stop hunts. So we've got three layers of things going on here, which give our trade a nice clean edge to get in and out. And we've done it in a way where we can get a lot of precise entries, precise exits, precise stop losses, which really enable us to getting a nice profit from the market and being able to squeeze money from the market and do it in an efficient way. Again, just by looking at a silver chart, we can see this kind of Elliott wave, this cyclical patterns in markets, how you have these insane impulses, these crazy phases, then you have crashes, you have these long accumulation phases, and within these accumulation phases there's so many corrections, there's so many range fake outs, etc. There are impulses within all of these phases. Then you have these longer term impulses. So just by looking at silver itself over the last 40 years, we can really interpret the way that psychology happens in the market, the way that these corrections can happen, these consolidation phases. That's something to bear in mind. So again, if we look a bit closer at expanded flats, these are very, very similar to the corrective strategy, although they do calculate a bit more in terms of looking for waves. We don't necessarily need to look for waves, but we can count the waves if we would like to do that extra layer of analysis when we're looking for setups. But again, it's a very consistent theme. Having these strong impulse down, then you have a retracement phase, then you have a move lower, testing that support layer here, testing that area. Then you kind of get this spring action, and then it comes back above here, targeting that C area, and that's where we're getting out. So we can, this strategy works very well, and this is a similar kind of corrective setup. And that's why I often say it's important to our traders. If the move happens, sometimes the move happens too quickly, we have an impulse retracement, and then it quickly goes. Those aren't often the trades we want to be in. We want some kind of range being formed, or some kind of action in here, some kind of support that's been established that can then be, attacked and stop people out. And then that's where we're getting in, when people are stopping out, or where people are, sell stops are being triggered and people are going short. And you can see the same thing on the other side. We see these kind of structures in markets all the time, especially as you get familiar with the corrective strategy. You start to see it everywhere. These impulses, these moves, and these rallies higher, which then have a collapse. So yeah, that's a common kind of setup. So as I've touched on already, psychology is really the key that moves markets. When we look at any price, we are just interpreting the collective consciousness of all the participants. Price represents the thoughts of individuals and entities involved with an asset. And humans are creatures of habit, as I've said already. Patterns are repeated. We do the same things every day. I'm sure all of you watching have your routines, or you have habits that you do, whether they be bad habits or good habits. It could be meditation, it could be cold showers, or it could be smoking or drinking too much coffee, too much alcohol, whatever it is. We are creatures of habit. And the same thing happens in markets. Markets are no different. People react the same way. People have fear, people have greed, and when people have these strong emotions, they make mistakes. And when people make mistakes, there's opportunities in the market for you to take advantage of that if you can have a bit of a clearer mind than others. When someone is being silly and getting out of a trade, you could be getting in, or when someone is being silly and getting into a trade, you can be getting out. So yeah, just by looking at this diagram, you can see you have these different phases: optimism, enthusiasm, exuberance, euphoria. Then the euphoria ends and it's anxiety, denial, not wanting to get out, fear, despair, panic, capitulation, disencouragement, dismay, hope, relief, and then back to optimism, and the cycle repeats itself. So having those greed phases and those fear phases, I'm sure we've all experienced that in our trading. I know I have, for sure. I've experienced every kind of emotion when it comes to trading. Seasonality. Again, this is a very important one to be aware of. There are seasonal cycles. There are things that happen over and over again. You have particular assets that perform at different times of the year, particular assets which do better at certain times of the year. GBP, for example, GBP/USD typically makes a high in the summer. You can check that on the chart. It typically rallies and then sells off around June or July. And within these cycles and these opportunities, there are many opportunities for us to trade. Just by looking here at the seasonality of the dollar index, we can see again that there's all these rangy phases. These rangy phases, they're where we're being active. Many retail traders out there would say, no, you don't want to trade when the market's ranging. We want to trend. We want to trade when the market's trending, but the market's trending only 30% of the time. So all that other time that we could be taking alpha from the market, when a lot of traders aren't looking at the market, they're going, oh, the market's ranging, and they wait for it to trend. There's all these opportunities, these fake outs, these these participants being squeezed, these nice little bread and butter trades, as I often call them, that are just nice simple trades. You can get in, get out, get paid. We can see that here just by looking at this. We've got all these phases. We've got these ones happening on a higher time frame, ones happening on a lower time frame. We can take advantage of all of them, or just some of them, depending on our preferences.